For most Americans, home insurance used to be one of those bills you paid without thinking much about it. The company hoped your house didn't burn down. You hoped your house didn't burn down. Everybody moved on with their lives. Then the bill arrived, and suddenly people started paying attention. Home insurance premiums across the United States rose by an average of 21% in 2023 alone. Not over a decade. Not over 5 years. 1 year. A single trip around the sun. The national average annual premium is now over $2,000. In some states, homeowners would be thrilled to pay that little. Florida homeowners, for example, have opened renewal notices only to discover their premiums jumped 40%, 50%, even 100%. No claim filed. No hurricane damage, no house fire, no unfortunate incident involving fireworks and poor judgment. Just a letter politely informing them that the privilege of protecting their home now costs dramatically more than it did last year. The insurance industry even has a name for this experience: renewal shock, which is a professional way of saying, congratulations. Your insurer has decided your zip code is much scarier than it used to be, and that's what's making people angry. Many of these homeowners did everything right. They paid their premiums. They maintained their homes. They never filed a claim. Some have lived in the same house for 20 or 30 years. Yet one day, a spreadsheet somewhere decided they had become significantly more expensive to insure. Because insurance isn't really about your house. It's about risk. And lately, the insurance industry has become convinced that risk is getting a lot more expensive. The question is, what do they see that everyone else doesn't? Now here's where the story gets even better. Or worse, depending on whether you're a homeowner or an insurance executive. Most people assume that if they're paying more, they're getting more. A bigger house costs more. A better car costs more. A first-class airline ticket costs more. Home insurance has chosen a different business model. Americans are paying more while receiving less. It's actually impressive when you think about it. Premiums are rising, but coverage is quietly shrinking. Deductibles are getting larger. Exclusions are multiplying. And filing a claim has become increasingly complicated. Take deductibles. Many homeowners still think of a deductible as a mildly annoying expense. Maybe $500, maybe $1,000. Something unpleasant, but manageable. In many high-risk states, those days are disappearing. Today, some wind and hurricane deductibles are calculated as a percentage of your home's value. That sounds harmless until you do the math. A homeowner with a $400,000 insured home and a 5% wind deductible could be responsible for the first $20,000 of damage before the insurance company pays a single dollar. $20,000. At that point, you're not just insured. You're practically co-insuring your own house. Then there are the coverage restrictions. Insurance policies have always included fine print. But lately, the fine print seems to be getting promoted to management. Certain types of roof damage may be limited. Certain forms of water damage may be excluded. Mold damage is often restricted or excluded entirely. Every time insurers identify a category of claims that costs them a lot of money, they become extremely interested in finding ways to cover less of it. And when homeowners actually file claims, disagreements have become increasingly common. The homeowner's contractor says repairs will cost $30,000. The insurance company's adjuster says $12,000. The homeowner then discovers a whole new hobby involving paperwork, inspections, appeals, phone calls, and learning unfamiliar legal terminology. None of which appeared in the cheerful television commercials featuring happy families and golden retrievers. And that's the frustration driving so much anger. People aren't just paying more. They're paying more while taking on more risk themselves. Which raises an uncomfortable question. If homeowners are paying more, covering more of the risk, and accepting more exclusions, what exactly are they getting for the extra money? At this point, you might think the insurance industry's solution is simple. Raise premiums. Raise them enough, and eventually the business becomes profitable again. That is normally how insurance works. But in several states, insurers have started doing something far more alarming. They're leaving. Not raising prices, not limiting discounts, not tweaking coverage. Leaving. Entirely. And when a company whose entire purpose is selling insurance decides it no longer wants to sell insurance, that's usually a sign that something has gone very wrong. Take California. Over the past few years, major insurers, including State Farm and Allstate, stopped writing new homeowner policies in large parts of the state. Think about that for a moment. Insurance companies exist to insure things. That's their business. Imagine a restaurant announcing it no longer wants to serve food, or a gym deciding exercise is too risky. When insurers voluntarily walk away from potential customers, it means the underlying math has become deeply uncomfortable. The culprit, according to insurers, is wildfire risk. California has experienced some of the most destructive wildfires in American history. Entire communities have been wiped out in a matter of hours, and insurers have paid billions of dollars trying to keep up. Eventually, some decided they didn't want to play anymore. Then there's Florida. Florida isn't just experiencing an insurance problem. Florida is becoming the insurance industry's stress test. Over the last several years, more than a dozen property insurers either became insolvent or withdrew from the state's market. Not because people stopped buying insurance, because the companies couldn't make the numbers work. Hurricanes, litigation, rising construction costs, reinsurance costs, everything hit at once. The result is a market where finding affordable coverage has become increasingly difficult and where many homeowners are being pushed into state-backed insurance programs because private insurers no longer want the business. And then there's Louisiana, a state that suffered a rapid succession of major hurricanes, including Laura, Delta, Zeta, and Ida. The damage was enormous. The claims were enormous. And eventually, many insurers decided the risk was enormous too. Several carriers left the state, leaving homeowners with fewer options, higher prices, and less competition. And that's what makes this story so unusual. Insurance companies are supposed to spread risk. That's their entire purpose. But in California, Florida, and Louisiana, insurers are increasingly looking at certain neighborhoods, certain zip codes, sometimes entire regions, and deciding the risk is simply too great. Which raises a troubling question. If the companies whose business model is built around taking risk no longer want that risk, what exactly are they seeing? Now we get to the part almost nobody talks about. In fact, most Americans have never even heard of it, which is unfortunate because it may be one of the biggest reasons your premium keeps rising. It's called reinsurance. And if regular insurance is insurance for homeowners, reinsurance is insurance for insurance companies. Yes, insurance companies buy insurance. The entire industry is basically turtles all the way down. Here's why. Let's say an insurance company writes 100,000 homeowner policies in Florida. Everything looks fine. Then a major hurricane arrives and attempts to convert parts of the state into a debris field. Suddenly, that insurer could be facing billions of dollars in claims. That's a problem. Even large insurance companies don't keep unlimited amounts of cash sitting around waiting for disaster season, so they transfer part of that risk to giant global firms called reinsurers. These are massive companies that insure risks all over the world. A hurricane in Florida, an earthquake in Japan, a flood in Germany, a wildfire in Australia. All of it ends up in the same global risk calculation. And this is where things get interesting, because your premium may not be determined primarily by your house, or even by your state. It may be influenced by disasters happening thousands of miles away. A reinsurer sitting in Munich might be looking at losses from hurricanes, floods, wildfires, and earthquakes across multiple continents and deciding that catastrophe risk everywhere has become more expensive. When that happens, they raise their prices. Then, insurance companies pay more for reinsurance. Then, homeowners pay more for insurance. Everyone passes the bill to the next person in line. And guess who stands at the end of the line? You. What's remarkable is that most homeowners never see any of this. Your renewal notice doesn't say, global catastrophe exposure has increased and international reinsurance markets have repriced risk. It says something vague like, due to current market conditions, which is technically true. But it's a little like explaining a shark attack as an unexpected aquatic event. The really controversial part is what happened recently. After years of expensive disasters around the world, many reinsurers dramatically increased prices. Some even began reducing exposure to certain high-risk regions altogether. In other words, they weren't just charging more. They were becoming less willing to take the risk at all. And that's a problem. Because if insurers can't buy enough reinsurance, they often can't write as many policies. Not because they don't want customers. Because they literally can't afford the downside if a catastrophe hits. Which means when a homeowner in Florida, California, or Louisiana receives a shocking premium increase, the decision may not have been made by the company whose logo appears on the policy. It may have started with a risk analyst sitting halfway around the world. And that's the hidden story. Most Americans think they're negotiating with their insurance company. In reality, their insurance company may be taking orders from an even larger insurance company that they've never heard of. At this point, it's easy to frame this story as a battle between homeowners and insurance companies. Homeowners think insurers are charging too much. Insurers think homeowners don't understand the risks. But there may be a much bigger story hiding underneath all of this. What if insurance companies aren't just reacting to risk? What if they're warning us about it, Think about what's happening. In many parts of America, home prices remain extremely high. People are still buying. Developers are still building. Real estate agents are still describing properties as highly desirable. Everything appears normal. Meanwhile, insurance companies are moving in the opposite direction. They're raising premiums, reducing coverage, leaving markets entirely. Those two trends should not be happening at the same time. The housing market is saying, this property is incredibly valuable. The insurance market is saying, this property is incredibly dangerous. Eventually, somebody is going to be wrong, or at least less right. And that's what makes this so fascinating. Insurance companies aren't guessing. Their entire business depends on accurately predicting future losses. They employ armies of actuaries, catastrophe modelers, engineers, meteorologists, and risk analysts. If they underestimate risk, they lose billions of dollars. Sometimes they go bankrupt. So when insurers decide an area has become too risky, they aren't making a political statement. They're making a financial one. And financial statements tend to be brutally honest. Nobody pays billions of dollars to be wrong on purpose, which leads to an uncomfortable possibility. The insurance industry may be seeing risks that the housing market hasn't fully accepted yet. Imagine two identical houses, both worth $700,000, both on beautiful streets, both with great schools nearby. One costs $2,000 a year to insure. The other costs $15,000. Are they really worth the same amount? The housing market often says yes. The insurance market increasingly says no. And if insurance costs keep rising, that difference eventually matters. Because people don't buy houses, they buy monthly payments, mortgage, property taxes, utilities, insurance. That's the real number. And if the insurance portion keeps growing faster than everything else, it changes what buyers can afford. It changes where people want to live. It changes what lenders are willing to finance. In other words, insurance doesn't just protect the housing market, it helps determine its future. Which is why some analysts believe the insurance industry is becoming an early warning system. Not for hurricanes, not for wildfires, for property values. Because long before a housing market admits there's a problem, insurance companies have already run the numbers. And increasingly, those numbers are making them nervous. That's the real controversy. Maybe the insurance industry isn't overreacting. Maybe it's the first major industry that's been forced to confront risks everyone else is still debating. So let's step back for a moment. This isn't really a story about premiums. It's not even a story about insurance. It's a story about risk. For decades, Americans decided where they wanted to live, and insurance companies figured out how to insure them. Build on the coast? No problem. Build near forests? No problem. Build in hurricane country? We'll calculate the premium. That was the deal. But something appears to be changing. Increasingly, insurance companies are looking at certain places and deciding the risk no longer makes financial sense. Not because they dislike the people who live there. Not because they suddenly forgot how insurance works. Because the numbers are telling them something they don't like. And here's the uncomfortable part. Insurance companies don't communicate through speeches. They communicate through prices. A politician can promise that everything is fine. A real estate developer can promise that property values will keep rising. A lender can approve a mortgage. But an insurance company has to put actual money behind its opinion. And lately, those opinions have become increasingly pessimistic. Premiums are rising. Coverage is shrinking. Insurers are leaving. State-backed insurers are expanding. None of those are signs of a healthy market. They're signs of a market struggling to price risk, which raises a question that goes far beyond insurance. What happens when the places Americans most want to live become the places insurers least want to cover? Because if insurance companies continue moving in this direction, they won't just be changing premiums. They'll be influencing where people buy homes, where developers build communities, where banks issue mortgages, and ultimately, where Americans choose to live. In other words, insurance companies may be doing something few people have noticed. They may be quietly redrawing the map of America. Not with elections, not with legislation, not with bulldozers, with prices. And if that's true, then the home insurance crisis isn't just an insurance story. It's the beginning of a much larger story that the housing market, the government, and millions of homeowners may only be starting to understand.